Hi! In order for you to understand what interval funds are, first let us understand how mutual funds are classified. Mutual funds are broadly classified into two categories. They are open-ended schemes and close-ended schemes. Open-ended are those schemes in which an investor can invest or pull out his capital any day. These funds pose no entry barriers and can be redeemed anytime, even after the new fund offer. On the other hand, close-ended are schemes which have a fixed lock-in period. After investing in such a fund, an investor cannot redeem his capital anytime. You cannot invest in a close-ended scheme at any time, as this fund closes for new investments after the new fund offer period. Coming somewhere in between open-ended and close-ended funds are interval funds. In an interval fund, an investor cannot invest or redeem their capital anytime, but only during specific periods. These specific intervals are determined by the fund manager. During the permitted intervals, an investor can buy or sell the fund units at the prevailing net asset value, that is NAV. So, as the name suggests, a debt interval fund is a type of an interval fund which invests in debt instruments such as bonds, treasury bills, money market papers, amongst others. Based on the frequency or the number of intervals that the fund is open for buying and selling, these funds are of four types: yearly interval funds, half-yearly interval funds, quarterly interval funds, and monthly interval funds. A yearly interval fund will be open for transaction only once in the entire year, whereas a monthly interval fund is open for transaction once every month. On average, debt interval funds do not have the best returns. They are usually in the range between 7 to 9%. These funds are meant for investors who have a short-term investment horizon and a low-risk appetite. Thank you for watching the video.